Good afternoon and welcome to our 2024 Crystal Ball Market Outlook. I'm Katrina Radenberg, Chief Investment Officer for Mariner Wealth Advisors, and I'm here with my colleague Jeff Krumpelman, our Chief Investment Strategist and Head of Equities. Jeff and I were just chatting a few minutes ago about how much more fun it is to be with you today for this annual exercise following a highly profitable year in 2023, during which the S&P 500 generated a total return of more than 26%, and virtually all asset classes generated nice-sized gains. We've all just witnessed a robust Santa Claus rally and have seen the S&P 500 rise further this year to hit a new all-time high in 2024's first month of the year. Now trading at almost 4,900, the S&P 500 just burst through its prior record high of 4796 set way back in January of 22. The setting and general mood early this year stands in stark contrast to our experience this time last year when we gathered with you on the heels of a rough 2022 in which the S&P 500 declined over 20%, and practically all key asset classes fell in value. That was certainly a more challenging assignment, no doubt. I know you probably agree, right, Jeff?
Yeah, oh, absolutely. I sure do, Katrina. And yeah, you're right. I mean, it's nice to see folks in a much better mood. And we ourselves, we never want to become complacent. And I do think that that's one of the wall of worry items that's out there in itself. You know, has the market gone too far, too fast? Can we trust this surge to new highs that you just mentioned? And are folks just so giddy right now that we're poised for a fall? And, you know, we talk all the time. So we really do believe that the recovery that we've seen in the market and the solid returns that we saw in 23 and what we expect for 24, that it's for good reason. You know, it's based on solid fundamentals. But it took the crowd quite a lot of time to come full circle and come around to our kind of constructive view. And now, you know, this time last year, we were contrarians. Now consensus agrees with us. So it does beg the question, you know, should we maintain our positive thesis? Is it still intact? Mm-hmm. And after a lot of discussion and work and research, you know that, yeah, we do think that it's intact.
Yeah. Well, we'll definitely get to our specific outlook for 2024, as well as our thoughts on the wall of worry items that you do mention. But before we do that, I thought I would just make a few more introductory comments and share some observations on last year that have brought us to this point now. So to start, we are very pleased that we had a good message and positive thoughts on last year's crystal ball presentation. Much of the world at that point in time was full of negativity and predictions of more bad news ahead for 2023. I don't want to get too far ahead of things, but as a quick advertisement or a Cliff Notes version, I will tell you that we do forecast additional positive returns this year, though not quite as robust as we forecast and experienced last year. In terms of our contrarian views that Jeff mentioned and the positive view we had last year, we felt that the damage had already been done in 2022 via the sizable sell-off in stock prices that year, and that news flow regarding the economy, interest rates, and inflation, as well as earnings, was likely to be better than feared throughout 2023. That led us to believe we would see a meaningful rally last year, if not a new bull market. It feels good to be in front of you today and be able to say that our message played out. This constructive message wasn't one grounded in hope. It really emanated from two factors. The first was our thorough and ongoing review of the three levels of analysis we conduct: disciplined evaluations of the fundamentals of the economy and the financial markets, the valuation levels of the major stock indices, as well as individual stocks, and the technical backdrop of the market, including investor sentiment and price trends. These were all moving in a better direction as we moved into the final months of 2022 and the beginning of 23, a very good sign. The FETs, as we call them for short, were neutral at worst, if not borderline positive, while many investors were bearish. Historically, that has been a good signal that the stock market is poised to generate solid returns rather than lose money as the crowds might expect. Second, we know from studying history that the economy and the stock market are two separate animals. They do not move in tandem. Just because one is doing well or poor, it doesn't mean the other will follow suit. We made a concerted effort to make this point during last year's call. If you study history and fact check this, you'll note that often the stock market rises in the midst of recessions or falls in the midst of expansions. 22 was a great example of the latter case, as the S&P 500 declined while the economy and earnings continued to grow. It seemed rational to us, therefore, that 2023 could likely be the exact opposite case, a year in which the economy would slow, yet the market would do well. Even if we moved into a mild recession and earnings slowed or fell modestly in 23, we figured that the market would likely still advance. You might ask, how can we explain this or have conviction about such a scenario? And the answer is the evaluation of the economy tends to be a rear view mirror exercise, particularly given that key economic metrics are reported with a lag. Most of those metrics tend to simply provide a snapshot of activity at a particular moment in time. Evaluation of that data is worthwhile, but it also tells you little about what the stock market is likely to do once it digests this data and the lagging metrics. The stock market tends to be more anticipatory in nature and to move in advance of where the economy may be headed. In that vein, in our discussion with you at this time last year, we noted that the S&P 500 had already declined 25% from peak to trough in 22 in anticipation of a recession and an earnings meltdown in 23 that has proven to be elusive and may not even happen still. We suggested last year during the crystal ball outlook that the market was likely to advance by 15 to 20% in 23, given our observations of the data, the FBTs, that were holding up much better than the bearish forecasters had speculated, and because the stock market's associated expectations for resumed growth in 2024. In other words, we thought the market would rise in 23 in advance of an expected 24 recovery, given its anticipatory tendencies. Interestingly, the market's instincts have seemed to be spot on in 23 in terms of anticipating the earnings recovery that began in the second half of the year and looks to extend into and throughout 24. This stands in contrast to the market's misreads and missteps in 22. So Jeff, let me bring you in on this. Let's look at 23 details and get your thoughts on how this sets us up for the new year. And maybe you want to do a little pat yourself on the back for a job well done in 23.
Well, I didn't anticipate that, but we've got a great team, and it really is. It's gratifying when your instincts and your work really come to play out. And that's what happened last year. And I know we've got a slide on review of the year. It's just fun. You have a year like 23, it's just fun. I mean, if you look at that far right-hand column, 2023 full year return figures for all of those indices up there on the equity side on the left on that table, and then on the right, even fixed income, they're all positive, and the equity indices are really positive. But the bond index itself, after a rough 22, was up 5.5%. Much of that came in the final quarter, but it outpaced where we're at in inflation now. Inflation's back running, around 2.5%. So even that is providing a nice after inflation or a real kind of return. So look at that S&P 500, the second row down. S&P 500 index up 26.3%, as you said, and ended up the year somewhere just shy of 4,700, which was smack in between our base case forecast of 4,500 and our optimistic case of 4,800. So, is one of the rare positive voices. It played out kind of right as we expected. But the thing is, we wanted to include the various time periods on here because it really climbed the wall worry last year. There were a lot of things out there to scare people to death in the headlines. And so it wasn't a smooth ride. There was a lot of volatility last year. and three different chapters in the market. People were worried about inflation kind of throughout. Is it really going to calm, or is it 1970 styles inflation? What is the Fed going to do? They keep sounding really just mean and ugly, and they're going to hike to the moon. I mean, are they ever going to stop? There was worry about that. We had wars, and it ended up wars on a couple fronts. You had in March concern about a banking crisis and a run on a couple banks. And then right kind of midsummer, you had concerns about debt ceiling debates and a government shutdown. And in the fall, you had a surge kind of in rates. The 10-year yields rose above 5%. People were worried about our fiscal debt, that kind of thing. And so kind of a roller coaster. But, all of that headline stuff was trumped by the data that came out. And when it would come out kind of throughout, every time it was released, it would prove that inflation is coming down, that the economy is continuing to expand and be really resilient. We're not in the midst of a recession. In fact, we had 5% growth in Q3 real GDP. And then the number that just came out today for fourth quarter of last year was 3.3%. People were expecting 1.5 to 2. It was 3.3. That's not a recession. That's pretty darn robust. We do think things are going to, slow down in 24, but that recession never happened. So that is enough to make an investor's head spin. The data would calm, but then the headlines, people come out and say, this guy Jerome Powell keeps talking ugly, and I don't know, maybe because they're doing that, we'll finally have a recession anyway. And then the data comes out and it calms everybody. So the three chapters were January to July. You see the S&P 500 advanced 20.7% in that first 7-month period, because the data was coming in that calmed people. But then, of course, they all worry because Jerome is getting ugly. She's remaining ugly on I'm going to hike. And so we get this peak to trough sell-off July to October, about 11%. And then we get a wonderful Santa Claus rally because the data comes out and no, sorry, inflation really is calming down. We solved these wall of worry issues pretty well throughout the year. Earnings look pretty positive. Rates have calmed back down as inflation has. And, things look, pretty darn good. So that is enough to make an investor's head spin. And we're, again, gratified that our message throughout that was, please don't take non-productive asset action and sell down your equities. Hover and stay ingrained at your long-term stock allocation. And I think that's very important to avoid whiplash in an environment like this. And, we'll talk about that in just a second. But if you would have, a lot of people wouldn't have even been in the market January, July, because they were still depressed about 22. So we were saying at that point in time, hey, make sure you're at your long-term allocation. Then, you would have probably gotten depressed in July and October, but that was short-lived. And then you get the rally. So, avoid that whiplash. The other points that I'd like to make here real quick, Katrina, I think they're important. And it's part of that page or that poise and patience kind of message. A lot of the experts last year were saying, get out of growth, run away from growth. They're long duration assets and rising interest rate environment. They're not going to do well. Our take on that was, well, wait a minute, bottom up. You can't just be some kind of ivory tower kind of person that makes decisions just on rates rising. Have you looked at the earnings? Have you looked at the end markets of some of these growth categories? Like technology, have you heard of a thing called, AI and electric vehicles and cloud? That's got legs. And so we were actually buying some of those growth stocks, the NVIDIAs of the world, Palo Alto, cybersecurity, CrowdStrike. Within consumer discretionary, we're buying things like Royal Caribbean and Deckers that makes the Hoka shoes that now is all the rage. But these were great growth stories. And you can see the Russell 1000 growth index down there at the bottom for the full year was up 42%. The more defensive postured Russell 1000 value index that has a lot in those value areas like staples, energy, utilities, REITs, that kind of stuff, only up 11%. Our message was have a blend between the two. And that ended up being value add last year. So we're glad that we didn't, drink that Kool-Aid to run away from growth. The other thing that I would mention on here is that people were very concerned, and I understand this, because the market was concentrated in the first 10 months of the year. A lot was about the Magnificent Seven, the so-called Magnificent Seven, the alphabets and Apples and Tesla, Microsoft, Nvidia, and those names. And the other 493 stocks really didn't show a lot of leadership or contribution. But boy, that really changed at the end of the year. And that's a great signal for 2024. It broadened out, leadership broadened out. We think it will continue to do that. And it's a great opportunity for an active manager as the rest of the market catches up and begins to participate with the stocks. And so we would flip that story on its head and say, we see good trend. And as we'll talk in a little bit, by the way, while we were underexposed and we still outperformed in some of our most aggressive strategies, internal strategies, you do not want to short the Magnificent Seven. They have great fundamentals. So, be careful about just panning a group that you read in the paper that, oh, we got a bubble going on here. We can talk about that later.
Yeah. Let's touch base on one of the points you did make there near the end around whiplash. You mentioned that, and I think it's important for you to hit on that a little bit more and just talk about why we feel it's so important to really help our clients avoid whiplash at such volatile times, and how we do this, and maybe some examples of that might help.
Yeah, no, I really appreciate, I know you have great conviction on this. Some of our colleagues, Brad Rollins, who gets very involved in asset allocation and that kind of thing. And it's a really important point here. I think many times people expect their investment manager to get too cute and, to market time. And it's not laziness. It really is fact that market timing most of the time is just a bad idea and it can't be executed well. I don't care what kind of algorithm or process or system you have. And market timers generally get involved. They get too tied up in the emotions of things, certainly the individual. And when they market time, they sell too late. And the reason that they sell is more emotional in nature. They see the market starting to sell off, even if the data is good, but they just see the trend in the tape. And so they run away, and then they never get back in as the data remains strong. And even you get confirmation when the data comes out, additional data, and it shows, well, that was an overreaction. It shouldn't have sold off. The data is still good. They don't get back in because they're kind of paralyzed. Mm-hmm. And so you suffer most of the downside and you don't get the upside. And last year that would have happened. As I said before, a lot of people, the folks that were probably market timing and oriented would have missed January to July. They finally would have come in late in the summer period and missed most of that upside. Then all of a sudden, folks are getting pessimistic. The headlines are terrible in July to October. They sell, and then they don't get back in October. And I could go through December of 2018 when, that was when we had political stuff, rhetoric about trade wars, and you had the yield curve back then invert for a nanosecond. People predicted a recession in 19 that never happened. We saw the data is really good. Hey, man, you might even want to become, increase your equity exposure because of the 21% downdraft in December, because the data is still good. We have 10 to 20% corrections each and every year. And most of that stuff is just based on psychology and emotion. The data generally is good in the market. We're only in recession 13% of the time. Bill Greiner can tell you, until the cows come home about, what a great country this is. And the economy is usually in a really good mode and the stock market's up 75 to 80% of the time. So it's okay to be negative, but the data better be negative before you get involved in trimming down your equities. There are moments, the 1930s are a great example. In the 30s and early 40s, bad time. The 70s, you got Watergate, whip inflation now, oil embargoes, that kind of stuff, a couple recessions in there. The data got negative. So, you could make some adjustments. And then certainly in the tech bubble in 07, 08. But there are decades in between that stuff. Most of the time, the data is neutral or positive, and therefore, so should you be with, your asset allocation. So I think that's just really a key point.
Yeah, no, I appreciate you mentioning that, because we used to have the slide in here that shows like what happens when you miss out on those days by trying to market time it. We should bring that back at some point.
Right.
So let's go ahead and move on and talk about what we got right in 2023.
Sure. And so, we're going to talk about what we got right and what we missed. I think we've talked mostly about what we got right, but in summary fashion, we were a rare positive voice out there. We thought we would see double-digit returns in the S&P 500, strong double-digit returns. We got them. We had a target of 45 to 4,800 on the S&P 500 last year. We thought growth stocks would do well, as I mentioned. We thought inflation would actually calm. And we didn't think transitional was a bad word for inflation. We really did think that it would be more like the 1950s, where it would come in from temporary supply constraints and labor tightness in the labor market, much like the 1950s, not like the self-fulfilling prophecy in 1970s from commodity prices getting out of control, cost of living increases built into union contracts, all that kind of stuff. We just didn't see it. Earnings, we thought, would be far better than feared. The bearish camp was saying that we're going to have a hard landing recession. Earnings are going to crater, 20%-ish. And we just didn't see that in the data that was out there. And we did think that rates would stabilize at a higher but healthy level. Finally, you're getting 4% on intermediate bonds. And isn't that great? People on fixed incomes that need that income are finally getting it. That's actually a healthy thing, not a bad thing. And we thought that Fed rate hikes would peak just at about the levels that they did. We went on record in saying that, and I know we'll talk about that later. But we got those things right. I guess if we had to apologize anything about anything, it's just too hard to do this. But we didn't get the timing of the advance in the market exactly right, because we had those different chapters. It started to recover pretty quick early last year. And that the swiftness of the advance in the first half of the year surprised us. We thought it would be largely back end loaded. It did end up, really giving a nice Santa Claus rally, but we thought most all of it would come then. I think a lot came earlier. And then the sustained, narrow, concentrated feature of the market, it didn't hurt us in our actively managed internal strategies in any way. We did fine being equal or underweighted those magnificent seven. But it did surprise us a little bit that there was such sustained strength just in that group. And we're really glad to see it broaden out.
Yeah. Well, from my seat, I think in terms of as you do the comparison here on this slide versus what we got right versus what we missed, I'll take it every year. So I'm expecting the same kind of results for this year.
Well, I knew I'd feel the pressure. Okay.
So let's shift from past to future and talk about what our expectation is for the markets and our message for 2024.
Yeah, well, you mentioned this in your introduction, that last year we thought our theme was 2023 was likely to be the inverse of 2022. So, you might see a slowing economy a little bit, but great returns versus the expansion in 2022 and the poor returns. So that did pretty much play out. Our theme this year, which is what it's all about, is return to normal, back to normal. And so what do we mean by that? Well, if you look at all kinds of metrics, we're just going back to normal. After that 07, 08 housing implosion, and things got out of whack with interest rates and other metrics, we're finally back to the point where we see Fed funds at a more normal level. The average over the long term is just under 5%. We think that's exactly where we're going to be, later in the year. And so that's kind of return to normal. And rates were abnormally low for so many years, for almost 2 decades. We think that they're going to hover in that 375 to 425 or 450 kind of period or range for the 10-year Treasury. That's normal, so let's celebrate that. We think earnings growth will be more normal as inflation comes down and gross profit margins kind of rise a little bit in here. We think that will drive decent earnings growth somewhere in the order of 8 to 10. We might get lucky and see 11 or 12%, but that's more normal earnings growth than certainly we saw last year. And there's a whole bunch of other things that are normalizing. Labor productivity is increasing once again. Unit labor costs are going back to a more normal range as productivity increases, and the wage increases calm just a little bit. And there's just a number of factors that we think are going back to normal. So what does all that mean for the market? Well, we think there's a 60% chance, that's our base case, that the S&P 500 in that more normal environment, and I'd put GDP growth in that normal environment too. We're looking for 1.5% to 2% growth, not a recession, but 1.5% to 2% growth, which is, kind of been steady state. That's down a little bit from this year. This year is closer to 3%, which is a shock to the world. But it's going to slow a little bit, but normalize. And that should lead to consensus earnings somewhere around 275 a share in the S&P 500 in that 2025 period. If you slap a 19 PE on it, which is just a little bit below where we ended the year, you get 5,200. So, some people might question the PE and say, well, that sounds really high. That's nutty. What are you doing putting a 19 PE? We all know that when you get normal and steady state, PE levels can be slightly above the average for a long, long time. But I think what gives us even more confidence is that 19 times is distorted because you've got 7 stocks that have high PEs with these really high growth rates. You got 493 stocks that are trading at 15 times or below. So we see the opportunity for PE expansion a little bit in those 493, maybe a little bit of PE shrink in those 7, and net, you kind of end up where you're at 19, okay? There's a chance in an optimistic case that as people see that the economy pretty solid, inflation's calming, they get a little more giddy, they got a bunch of cash on the sidelines, they come into the market, and that drives the PE higher to that 20 times level, and you get a 5,400 target on the S&P. But, net, the bottom line is we see a 70% case of 5,200 or better on the S&P, which is a high single-digit price return and low double-digit total return from where we ended the year. Now, it may not, go according to game plan. Kansas City Chiefs have had to deal with some, kind of halftime adjustments, right, Katrina? I think you know that as well as anybody. So maybe that happens. And what might that be? Well, we think there's a 25% chance that, maybe inflation and rates are a little stickier than people would hope for. So you get a little PE contraction. Maybe they aren't 19, they're 17. And if that would happen, but you deliver still, because the economy is still solid, decent earnings growth, hit those consensus earnings, that's kind of a flat market after dividends. The pessimistic case is not travesty, but it's no fun. No one's going to be happy. My mom's not going to be calling saying, I'm so proud of my son here, in his role at Mariner, if we're down 14% price. And that's a situation where you get earnings, you get the economy softening a lot, you get a lagged effect from what the Fed's done, get earnings lighter, and you get still inflation stickier, you get PE contraction, and you get earnings more like 225 as opposed to 275. And then you got double-digit decline. But that's not travesty, and we only sign a 5% kind of case to that. So net with pretty positive, sober returns, not crazy great, but sober kind of returns in a more normal environment.
Awesome. Back to normal. Sounds like you're a fan of Michael J. Fox movies or something.
Well, I've seen that movie, a couple of those movies. So yep.
Though I guess we're both dating ourselves at this point with that comment. But I
Yep.
agree and spot on with our thinking. I know that the FETs have supported our positive yet consistent hold your ground view for some time. We talked about that last year too. Can you discuss the FET table that I pulled up here that you also will refer to as our yoga chart?
I did that for you, Katrina. I know you're a yoga fan, and I think it does calm everybody, gets that blood pressure down, which is a good thing when you do what we do. And if you can't do yoga, then do this, I think, managing a stock portfolio. So we look at this, and if there was a bunch of red up here, we rate fundamentals of the market, and you see all the subcategories that make up the fundamentals. How's the economy doing? How are earnings doing? What's Fed policy like? What about the trend in rates? What about credit spreads? We do look at M&A and IPO activity, and we rate all of those positive, neutral, and negative, which gives us an overall fundamental rating. We look at valuation on various metrics. How expensive is the market? And we rate that positive, neutral, negative. And then we look at the technical price trend. We look at, how bullish or bearish are people in the sentiment data. But we also look at, hey, what's the momentum look like? The percent of stocks that are now trading above their 50 or 200-day moving average. And when you look at this and mix it up in a soup bowl, it's neutral to leaning positive right now. That doesn't sound like an environment where you want to run away from stocks. The technicals are really very strong right now. They're very positive. And that actually has some people worried. So we need to address that. We don't feel that way. We think that that's a positive sign for the market. If we look at the fundamentals, we say neutral, that's actually a conservative rating. But let's talk about the economy on that front. You've got kind of a mixed bag, but I think it tilts neutral to positive. So you got, employment. We know the picture looks really good there with consumer employed, making, nice 4% wage increases, which is a good thing. So that supports disposable income and spending. Spending on services is really good. You got capital spending that has some support from some legislation that, looks pretty good, and improvements in labor productivity and that kind of stuff. So overall, the economic trends, those are the positives. The nits would be, well, housing and residential housing isn't so strong. If you look at manufacturing, that sector is weaker than services. But net, 3.3% GDP growth in fourth quarter with a strong consumer. So you got to give that the nod of neutral at worst. Earnings, because you've seen earnings estimates start to come up in Q3, Q4. Companies are reporting pretty nicely. Most of them are beating. So earnings trends are neutral to positive with more normalized earnings growth. Fed policy, they're finally saying we're going to pause. They're saying 3 cuts. We're going to cut 3 times next year. That's a support. That's moved from a challenge to a support. They'd moved to normal Fed funds rates, so it was neutral. Now it leans a little positive. Credit spreads are really tight. So, you mix that up in a big soup pot, like I said, and that's supportive of normal gains in the market, high single digit type, gains in the market.
Great. As much as I want to continue talking about positive things and the positive outlook, I think we would be remiss if we did not address the items that could go wrong. What's out there that we need to be looking for in the headlines this year, and what are some of the risk factors that might surface and appear in the media that could spook clients and investors?
Yeah, and I know, that's a big part of your role, Katrina, to throw a little cold water on things at times and just say, wait a minute, what could we be missing? What's out there? What do we need to really monitor? So I appreciate that. And as you know, we collect this wall of worry, what we call the rolling wall of worry. And both you and I are most nervous when there is no wall of worry, because it probably means that folks are too euphoric and, you know, we're poised for some trouble. But I guess the good news is there is one. On the left-hand side, these are the headline issues. What really matters is, do they have impact on what's going on the right-hand side? And right now, all those things on the right-hand side are moving in a good direction. But last year, the challenges that could have impacted these things on the right-hand side are down at the bottom. These are legacy issues that will linger into this year. What about inflation? What about the expectations for Fed rate cuts? Will they really do it? What about economic slowdown? That kind of stuff. And we really do think that those are more mature and seasoned and headed in the right direction. And we've got more inflation data out today. We're going to show you we're running around 2% on a go forward basis on inflation, which is very close to, you know, the Fed target. So we'll talk about that. We don't expect a recession next year. You just saw that. I think the things that are on people's mind are the three ones at the top that are probably worth talking about. Bullish sentiment. You know, have we gotten ahead of ourselves? Are people too positive and too giddy? Had a 26% move in the market. Can we really have a good year in 24 after 26% returns, you know, last year? Is that really smart to think that we can? And what about the Santa Claus rally and all these stocks doing well? Are we just, you know, getting ahead of ourselves? So I think we need to talk about that. Concentrated market. There's this story out there that, hey, if the Magnificent Seven have led the market in a big way and they stall and you don't get the others picking up, how can the S&P 500 index overall, you know, move forward? We think that this is an opportunity for active management, but we also think that there's overkill, over worry about this, the challenge of a concentrated market last year. And then you got politics. You can't help but talk about politics. So I think probably we want to attack these first two and you know, maybe talk a little bit about politics too.
Yeah, no, I think that's great. I think let's first address our take on the risks associated with the strong returns and the momentum being exhibited by the market in 2023's final months and at the beginning of this year so far. As we mentioned in the opening, the S&P 500 is at all-time highs and investor sentiment is bullish again. So what do you think? Are folks too exuberant, and is the market overbought? I mean, we're talking about it still being positive, but will this make it tough for the market to really generate the gains in 2024 as you outlined earlier?
I mean, the bottom line answer to that is no. We actually think this momentum is a good thing. It's positive for forward returns. And really, we needed to get here in order to be confident that we're in a bull market, in kind of a new bull market, if you will. And so it's true. I mean, if people want to get crabby about, oh my gosh, you know, we had a blow off move at the end of the year and we're now at all-time highs. Oh my gosh, that's a bad thing. People are too giddy. Well, first of all, let me make the point. Investor sentiment, people look at the percent of bulls versus the percent of bears. It is true that very bearish sentiment is a good signal for the market probably bottoming and getting ready to do well. It is not a good signal, and history will support this. I can show charts and graphs. We don't have it on here today. But it's not true that when you get a high number of bullish folks, that the market then rolls over. That's false. There are plenty of periods where bullish sentiment has been sustained for a long time. But we did have, in terms of momentum, the advanced decline line, the number of stocks advances versus declining, that really moved up nicely at year end. The percent of stocks trading above their 50 and 200-day moving average went from very low to very high. Actually, you can't be confident in a sustained advance in the market until it gets very high. And this is one statistic that's a momentum statistic that I think is telling and interesting. It gives you a sense for how strong the rally was, but what it means for future returns. So this table here captures the moments in time where the percent of stocks trading above their 20-day high, which is a 1 month trading number. There's 20 trading days in a month. When more than 70% of stocks trade above their 20-day high, that's only happened 5 times in history. And one of them was December of last year. And we show this in the middle of December, on the 14th of December, it hit 70.8%. As we moved through that month of December, it got as high as 77%, trading above their 20-day high. If you study history, you can ask the question, well, what's happened in those other periods when you've gotten that number of stocks doing really well, showing that kind of momentum? And in that dotted red line, you can see over the next month, it's kind of mixed. It's not necessarily a good thing. You can get a pause that you saw in things like 2020 and 2011 and so on and so forth. Returns aren't super robust. But then when you look out 6 and 12 months, look at those robust returns in the ensuing 6 and 12 months. So maybe you don't buy into this, but this isn't a tell-all, but certainly it does demonstrate that just because you've seen that kind of momentum, it doesn't derail the fact that you can have strong returns in the ensuing 6 to 12 month period and healthy returns like we're expecting. So I think we've got some data here too. What about the fact that the returns, I hear all the time, oh, we were up 26% last year, how can we repeat? Well, this shows you a distribution of S&P 500 returns in different categories or cohorts going back to 1926. The most common return category is plus 10 to 20% or greater than 20%. And greater 20% returns are the most common return for the S&P 500. Seldom do we lose money in that minus category on the left of this distribution table. And very seldom do you make a little return, 0 to 10%. Most of the time, they're pretty robust. The number of repeat years where you've had a 20% return followed by a 20% return year or a plus 10% year. And most of those kind of negative years, they're in the 30s, the 70s, those terrible periods that I mentioned, 07, 08. So don't think just because we had 26%, which by the way, just made up for the minus 22% in 22. It doesn't mean that we're fated to have a bad year. So that's how we feel about momentum.
Yeah, no, that's great. I think that helps paint the case there. Let's switch gears and talk about market broadening. So how about the skeptics who feel the gains last year were too concentrated in what you referred to it earlier, the Magnificent Seven, which is the 7 largest stocks in the S&P 500. And these are Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. The skeptics would suggest that this is a sign of an unhealthy market that's driven only by a handful of stocks, while the 493 others were weak performers, and that's a bad sign for 2024. So in other words, if the Magnificent Seven lose steam and the other 493 aren't poised to do well, how can the broad S&P 500 and other stock indices still do well?
So I think, because we've been vocal so far in this, I'll try and be succinct. These two tables track the percent of stocks trading above there on the top table, 50-day moving average, the bottom, the 200-day moving average. You can see in the first 10 months of that year how that line dropped significantly and it got really narrow. There were very few stocks trading above their 50 or 200-day moving average. Then it shot up like a rocket ship at the end. So what that says is all of a sudden those other 493 really started doing well and contributing. And we could see that in other forms that we'll talk about on the next slide, but that's a really good sign of health. And I want to make this point too. For those that say, oh, the Magnificent Seven, it's just crazy, they can't continue to do well. I can tell you right now, NVIDIA is an example of stock that we came into in the beginning. It was either late 22 or early 23. I forget exactly when in the general portfolios, but those are in the more aggressive portfolios. And the reason that we did that, it sported 150% revenue growth and 250% earnings growth. This year, it's guiding for 80% earnings growth, and it's only trading at 30 times. And if you went stock by stock, most of them, as a group, they look to grow earnings 20% in the coming year. we just bought Facebook in a couple of our portfolios because it's trading at 20 times, it's got 30% growth, and we're going in a political advertising year. So don't think that these things are sick and dead. They may not do as well on a relative basis. They may not lead, but it doesn't mean that they, are doomed to just travesty this year by any means. They've got really good fundamentals, and a lot of them, their valuation still looks very solid. So, I would make that point. In terms of other signs of broadening and leadership is what we want to see, where it's not just all a one-trick pony in this one area. The equal weighted S&P 500 versus the market cap weighted S&P 500, it well outperformed, the equal weighted well outperformed the market cap weighted. And you can see that line that looks at the relative return of equal weight versus market cap weighted, market cap being dominated by the top 7. And you can see the Russell 2000 relative to the S&P 500, the smaller stocks out there, well outperformed in the final couple months of the year. Those are all great signs for the market broadening, Katrina.
Thank you. So no surprise to anyone that we are in an election year. And so as the campaign is, I would say, set up to be another doozy. And how do we think politics might impact the markets?
Well, there's a reason why we say, we when we analyze markets, we make judgments on 3 things, whether it's a stock or the market: fundamentals, valuations, and technicals. We don't say fundamental, valuations, technicals, and politics. The politics create volatility and angst, and maybe even make us mad about whatever moral decisions people make in Washington and da-da-da-da-da. Totally get it. But we're focusing just on the financial markets. And so this is a chart and graph, and we tell people this. In the blue line, that's the performance of the stock market over time on average, going back to the 1950s for the S&P 500 in presidential election years, versus the red, which is all other years. Both are handsomely positive. Both have a positive slope over time. The real difference is timing. The first half of the year in presidential election years, people get a little nervous. So I'm not going to promise you this, but the tendency is for the market to be a little lazy early on. And then once we know who the nominees are and we know who the winner is, people get comfortable with, okay, I wouldn't have selected that person, but the rest of the country did. We know what they're about. We know the risks. And oh, by the way, they don't have a lot of impact. There's a lot of gridlock, and we really don't need to worry about a lot of things. So I'm not sure that, I think this year is going to be, even though it's ugly with all kinds of different facets to it, that will change that dynamic on the market. We'll continue to look at legislation, and we do know that open elections tend to be worse years than re-election years. This is a re-election year. You got an incumbent in there who wants to win. He will throw a lot of stimulus, the administration will, at the economy to make sure we're not in a recession at that election time in November. So that would be supportive for stronger growth, stronger earnings. And then what we do is an alphabet soup over here of different mixes of what party controls the White House versus Congress, every mix you can think of. And you can see that the performance is pretty even across that whole, portfolio of possibilities. The far right shows that if a Republican president and a Democratic Congress are in there, that returns are a little weaker. That's influenced by, just certain periods. Think of Watergate and that kind of stuff in the 70s. So that has, some influence on that. But generally, the market's positive regardless of what's going on. So that's why we say FVTs, not FVTs and Ps.
So you might classify this as a noise category.
I would, and it will cause volatility.
Yeah.
Temporary.
So let's revisit some of the more traditional risks that are out there. Can you update us on our thoughts on inflation trends and the market implications for 24?
Yeah, and I'm gonna be really fast on this part
Okay.
of it. Labor productivity, we saw a dramatic improvement in the tail end of last year on that. And that's because the quit rate went down. People quitting their jobs really softened, and people were getting more experience on the job. You got AI and other drivers. But if you can generate more output per hour of work, then companies can pay higher wages because they're making more money off of that worker without hiking prices, and they can sustain their profit margins while still giving decent wage increases to these folks. So that drives profits, that drives disposable income to workers, and it drives economic growth. And so that is a inflation offset. It's really good to see that trend. The other slide, alphabet soup of inflation, core, CPI, consumer price index, CPI headline, the PCE, both core and headline, and then we have the producer price index, the PPI. All of them, alphabet soup. You see that slope go down? It's going down. And we thought it would. And, I think we can honestly say inflation was transitional. That's a really good thing. And that's part of the reason why the market's moving in the right direction. If you go to the next slide, we are actually running below the Fed target of 2% right now on an annualized basis on core PCE. We're about 1.9%. So I think the Fed can cut. We'll talk about how aggressively. I really don't care about that, but they can cut because inflation's coming in. That's also good for rates stabilizing. On the next slide, this is a slide that we showed last year. And, it simply shows the periods in the top table of surging inflation. When did those periods happen? And, how much did it surge? What did it look like 16 months before we got peak inflation? What did inflation fall to 16 months after the peak? But the punchline's in the table below. How did the market perform after a peak? Not when it went back to Fed target, not when it went back to perfect, but after a peak. How did the Fed do? Or how did the inflation do? And on that table below, you see plus 12 months after the time period when we got a peak in inflation, the market was up 13.8%. Inflation peaked in June of 22. So we're past that 1 year period. The market was up 17.97%.
Hey, Jeff, your camera has shifted.
Oh my gosh. You know what? Sorry. Good thing you're here.
I know it was a test to make sure I'm paying attention.
Yeah, my bad. So, back to the table, inflation's peaked and the market responded. It didn't go back to perfect, but it just slowed. And that's all that has to happen. So, and then finally, this is a chart on inflation that shows a lot of people were saying it was going to be 1970s style inflation. And this is a chart that shows CPI going back to 1940s and, the ebbs and troughs. And in 1950s, we felt like this would be much more like the 1950s, where we were coming out of World War II back then. And so, labor was tight as we were just gearing up. Demand was really, as we were going back to a butter economy from a war economy, demand was really starting to scream. And all of a sudden, our labor force gets pulled into the Korean War. That resolved itself quicker than folks feared, and CPI quickly fell as supply constraints and labor constraints went away. We thought that's what would happen because it wasn't oil embargoes and crazy stuff that you had in the 70s. And so that's kind of what has happened. I think it's good to know history and not get caught up in these, really fears of hyperinflation that we saw in the 70s. And then the next slide, I guess this gets at Fed funds. Yep.
Yeah, this is where I want to switch gears and talk about Fed rate cuts. You mentioned earlier that we expect that in 24. And Fed policy has been such a big part of the story over the past 2 years. And now, again, this year will continue to be so. The market seems to be pretty convinced that the Fed will cut aggressively. Do you think they will? And I know you and Sandy have had a lot of conversations around this too. What's the impact if they do or don't?
Boy, you really ask those easy questions,
I
don't
do.
you? So first of all, I guess I'd just like to say, let's put it in perspective. The Fed did hike, but they only hiked back to normal. The average Fed funds rate is 4.9%, going back to the 70s. And so, it's not crazy what they've done at all. It's not punishing where they're at right now. So they're not pressed to have to cut in some big crazy way. I want to make that point. If you go to the next slide, this shows you what the real Fed funds rate is after inflation over time. And over the long term, going again back to the 1970s, the average Fed funds rate, if you deduct inflation from it, is somewhere around 1%. But you got two chapters, pre-tech bubble and housing implosion, and after that. And back then, the real Fed funds rate was around 2%. So let's say that the normal real Fed funds rate is 1 to 2%. Let's do the math. Right now, you've got a Fed funds rate of 5.5%. You've got inflation, let's call it 3%, just to, for grins. You've got a real rate of around 2%. That's at the high end of history. So they got room to cut. If you want to say, well, now it's actually running to 2, it's at 3, in terms of the real rate, 5 minus 2, then they need to cut. So, with inflation calming, they've got the ability and the purpose and the mission to begin cutting. I don't think they need to be aggressive. It's not crazy, but they need to, it will be good to see them start moving in the right direction. And they've got the support, if you will, the research to support that. If you go to the next slide, what people are really crabby about right now is they're saying, oh, the market's just, they expect all these cuts and it's got to happen. The market says 6, the Fed says 3. I just think that's kind of horse pucky. I don't care. That the big reason for that is I don't necessarily think they have to cut in some crazy mode. The economy's holding up just fine, and they're not pressed to have to be aggressive. So if they want to be measured and slow, they're signaling 3, and that's in that stair step kind of line that you see up top, where we're at 5.5%. And then they say, sometime in the fall, they're going to begin cutting. And by the end of 24, we're going to be at 4.5. I think that's fine. With regard to the market, these colored lines in there show you how crazy volatile the Fed funds future market is after we get data releases on CPI or whatever. It moves all over the map. So, I don't put much credence. The market doesn't know what it wants. This is just really kind of a crazy figure. And I think it will adapt if the economy continues to move just fine, inflation continues to ebb, 3 cuts to 4 cuts is just fine. And that's kind of what Bill Griner's looking at, somewhere in that neighborhood. And there are some economists out there like Dr. Siegel that says, hey, this Fed fund futures curve thing, it's kind of stupid anyway. It because of hedging activity, it is really only baking in 4, not 6 as advertised. We won't get into the math of that, and we won't necessarily endorse that, but it's just a wiggy kind of thing.
Mm-hmm. I know we're starting to run up on the hour, but I do think as we move through the end of the presentation and we're talking about the Fed and rates, it would be a good time to just discuss briefly thoughts on fixed income as we think about whether it's short rates, long rates. We're finally at normal levels again, healthy levels again for income on fixed income portfolios. At the same time, rates have been volatile. So talk a little bit about the interest rate outlook as it couples with bonds and just how people should be thinking about that as it relates to the portfolio.
Yeah, no, that's great. And I'm looking at the clock too. And I think this is probably, a real nice right before wrap up. I think it's a real nice way to do it. Sandy, Priscilla, it does an incredible job on fixed income. She could message this far better, I think, than you and I, but as her proxy today on fixed income, I think it's fair to say that as a group, what we can do at Mariner is bring institutional fixed income management to the high net worth world, because we've got scale, we've got the research, and we have the access. We can grab the bonds that we want to grab and put in client portfolios because of who we are and the amount of trading that we do, or buying that we do, buying and selling that we do. So that's point number one. And we are more constructive on the fixed income market that we've been in a while. We generally, I think, like to ladder portfolios, but in a modified way. The idea of a ladder where you have bonds coming due each and every year mitigates some of that interest rate risk, because you have something maturing that you can figure out if you want to keep it short or roll it out, depending upon what rates are doing. And we do that very effectively. We were very short, earlier. And over this last year, we've extended duration as those bonds have matured, or we have new cash coming into portfolios. Ever so in measured fashion, we've extended because we like the fact that rates have come up. We can add value because we can see relative value between the different component parts of the fixed income markets, munis versus treasuries, corporates versus treasuries, and that type of thing. And I think the volatility in the market, as we see rates move up and then back off and back down, the advantage that we can provide on that is we can pounce when rates rise like they did in the fall, and we can pause and chill when rates fall. And we've kind of done some of that. We're also very aware of the less attractive ratio. If you look at munis, they're more expensive relative to treasuries. So we're less aggressive, if you will, in that market, and in positioning and recognize when we're building portfolios that the municipals are not as attractive as they were relative to treasury yields. So, those would be, key points, and Sandy can fill in the gaps and answer any questions that might be out there. But we do think it's a good time to own bonds. We're comfortable with rates in this range, and we've extended duration would be the key points, I'd say.
It certainly makes it easier for investors and clients to want to have that allocation that we suggest having in the portfolio with rates more normalized.
Yep.
So all good points.
Yep.
Before we wrap up, I do think it's important to still hit, we talked about, that we do have, you and Bill, we've all talked about continuing to have neutral to positive feelings on the economic trends. Things are slowing down, but economy is still expanding. So why don't you, just talk about some of those key drivers of what we're looking at as we think about recession and economic growth?
Sure. So again, these are just kind of rapid fire things. I think that there's an unappreciated, the equity team thinks there's an unappreciated kind of capital spending picture that is out there. There was the CHIPS Act, there was the Inflation Reduction Act, which is actually an infrastructure bill. And that's going to drive, I think, spending on capital projects 2024 and 2025. And just today, United Rental, for example, a stock that we own in our actively managed portfolios, is up on a good quarter because of these underlying trends in capital spending. And so you can see all these colored things out there. Residential is that green line, that lime line that shows that was weak if you looked at kind of the trend over the last couple of years. But wow, if you looked at non-residential and multifamily, fine and strong, and construction put in place, all those lines going up. So I think that there's opportunity within the equity portfolios to take advantage of that, and it's good for the economy as something that can keep us out of recession as we re-onshore and that kind of stuff. On the next slide, this gets at forward earnings estimates. They're coming up. And so as inflation's calmed, companies have done a great job of managing costs. Some of their costs in terms of inflationary pressure is lightening up, and labor productivity is improving, and you see gross profit margins, going up, and earnings estimates. We're looking for, 10%-ish growth in earnings in 2024 and 2025. So that's pretty solid. Credit remains calm. If we were headed towards recession, these credit spreads would be reaching out. They're very tight. And that's, again, where Sandy can talk about corporate spreads versus treasury and that kind of stuff, but they're tight. And that means that the economy looks pretty solid. Mortgage rates, Bill Greiner done great work, on this part of the economy. And this could be an unappreciated lever for the economy as rates come down, good for the housing market, good for the multiplier effect and that kind of stuff. If housing activity, would pick back up as these rates, come in. Stuff to think about.
Yeah. Nope, those are all great. Let's go ahead and can you just tie up everything in a bow for us today, Jeff? As we leave and we'll be back in July, what are the key things you want to leave our clients with?
Those first 3 points up there, don't predict the predictors. So many people want to do that. They want to tell you where exactly inflation's headed and so on and so forth. We just look at the trend and where the momentum is and what it's trying, and we listen. If it's going back up, that's, we're not going to say, oh, that's temporary, it's going to come back down. We look at the trend. So don't predict the predictors. Look at the key metrics and see how they want to go. Patience is a virtue to avoid whiplash. And most of the time, the data is neutral to positive. So stop the temporary panicking to try and, get it out of the way of a 10% correction. If you do that, it's just a bad thing. We would maintain a blend of growth and value. We think when the 493 stocks start catching up, great time for active management through our internal strategies. And I just really appreciate the equity team and are working with the overall investment team in being able to do what we do and managing clients' money and our strategies. Sandy does a great job, she and her team, on the bonds and as a group. Bill Greiner's talked about this for some time. We think that they're more attractive, and you need to be smart in how you do that. We think we do a good job through individual bond management in that regard. And as the economy, holds up and the Fed cuts, we're glad small caps are a part, small and mid caps are a part of our overall equity exposure. And we're glad they are. We think that could be a pocket of strength as the market broadens. So I think those are the key takeaways.
Perfect. Jeff, I very much appreciate your time today and the effort that you put into providing this outlook. And I look forward to reconvening next January and having, the same successful playbook of what we got right. To all of our clients, we very much appreciate you tuning in, are grateful for the opportunity to serve you. And we wish everyone a prosperous 2024.
Absolutely.
Have a good day.